Weak dollar, strong euro, and pound in 2026. Right now, as you're watching this video, a quiet economic war is unfolding between the world's most powerful central banks. The Federal Reserve is cutting interest rates, while the European Central Bank and the Bank of England are taking a different approach. And that shift is already reshaping the currency market. We're seeing the dollar lose strength, while the euro and the pound start to strengthen. For anyone trading Forex, this environment can create a real opportunity or several, but it can also lead to costly mistakes. The market's focus has clearly moved ahead toward what central banks are likely to do next, and it's exactly this forward-looking shift that's starting to put pressure on the dollar. So why is this happening? Part 1. Why is the dollar weakening? Let's start at the source and look at what happens when Federal Reserve cuts interest rates. After a long period of tight policy, the Fed moves into a phase where it needs to support the economy. As rates come down, yields fall with them. The dollar becomes less attractive and it no longer offers the same level of return. Once that happens, capital begins to leave the United States and shifts toward markets where interest rates are still higher. Part 2. Why the euro and pound are getting stronger. Looking at Europe in 2026, inflation is still an issue, but the risk of a deep recession has eased. That puts the European Central Bank in a position where it can keep rates higher for longer. And in FX markets, how long rates stay high often matters more than the exact level. That's what supports the euro, especially against the dollar that is already moving toward lower rates. The pound is following a similar pattern. The UK economy is more sensitive, but the Bank of England tends to move more slowly than the Federal Reserve. As the market accepts that rate cuts are coming, just not anytime soon, the pound starts to get repriced higher. That's why going into 26, the pound could end up stronger than many expect. Part 3. The role of the Bank of Japan. Japan also plays a key role in this story. For years, the Bank of Japan kept policy extremely loose, which pushed capital out of the yen and into higher-yielding dollar assets. That phase is now ending, with multiple rate hikes packed into a single year, and that shift is starting to change capital flows. As returns on the yen improve, some of the money that moved into dollars starts to move back, and that puts more pressure on the dollar itself. Part 4. Opportunities and risks. So what does all this mean? Well, if you're trading these markets, that's an important question. When central banks move in different directions, volatility naturally increases, and that brings opportunity along with risk. Without a clear strategy, it's easy to get caught in those swings. But traders who understand the bigger picture and pay attention to higher time frames can actually use these moves to their advantage. These trends don't appear overnight, they develop gradually, often in the background, while impatient traders rush into decisions. If you want to learn how to work with these trends and manage risk more effectively, stay with us because we'll be sharing practical, actionable strategies very soon.